There's been calls for a long time, dare I say, prophesized about a deflation in the debt bubble that moves people out of growth stocks and the stocks being pumped with money and moved into commodities, especially commodities that we need, whether we're in a global recession or whether we're in the best of times. And one of those with the most black and white supply-demand fundamentals is uranium. And we're going to be discussing what's going on in the uranium market and how it all fits together with the macro environment playing itself out. I'm joined by my good friend, Justin Huhn. He is the creator of Uranium Insider. It is the best uranium newsletter, pure uranium newsletter that is out there breaking down the uranium thesis, uranium mining stocks to invest in. I'm a paying member myself. I highly recommend you check it out as well. Link to the description and pin to the comments right there down below to check out Uranium Insider. We'll give a shout out to our sponsor, Vizsla Silver, one of our favorite silver and gold mining stocks. I want to thank you for being a returner or stumbling new on today's video. If you enjoy it, make sure you hit the like button, subscribe, bell notifications, what notifies you for new episodes. There's really a war on money, on our fiat currency, on our savings. And this channel is all about helping you to prepare for that. So make sure you hit the bell notification. And Justin, good to see you.
Great to see you, Jake.
So explain to me, we're in such a bizarre time, right? Because inflation out of control. You're having global phenomena of supply chain disruptions, inflation. See what's happening in Sri Lanka. In America, there's supply chain disruptions of all sorts. I go to the gym and now every day I see the lower third on whatever news station now is all they're talking about is inflation. Biden meeting with Chairman Jerome Powell. Biden says this about inflation. It's the topic now. How does all of this fit into commodities and specifically uranium? And how does it fit into this larger decaying financial system?
Those are pretty complex questions with complex answers. And I think that there's a number of takeaways that we can come away with in terms of what to expect in a high inflation environment. First of all, high inflation environments, generally speaking, are supportive of commodities. Commodities are the real stuff of life. And many, and if not most of these commodities are essential for the functioning of society. And the prices of these tend to rise in inflationary environments, as with the price of everything. Most commodities are involved in industry and in modern society that is not necessarily discretional. So you have elements like copper and nickel and cobalt and uranium and oil and gas to a large extent that are needed in order for society to function in the modern industrial civilization. And so what happens is when prices of everything go up, really, the commodities prices obviously go up along with everything else. We've already started to see that happen in most commodities. And these commodities bull runs can last for a very, very long time. And we're looking at right now an outperformance of commodities relative to the broad markets, let's say, for less than 2 years. We're talking about maybe an 18-month move for the commodity bottom. So that's very, very exciting for somebody that's bullish on commodities, and especially for uranium, because of the fundamental nature of this trade and of this industry as it currently stands. And that essentially is we're sitting on a significant supply deficit for this year. We're looking at supply deficits for the coming years. That will be somewhat balanced with the expected restart of a couple of large care and maintenance mines. But if we go out towards the end of the decade, which is like that for uranium and nuclear because it moves so slowly, there's very large supply deficits. On top of that, you add an unbelievable growth trajectory for the sector. We're talking about 2 to 3% growth year over year, and that potentially could even be accelerated now with the talk of Japan restarting reactors faster than expected. We're looking at the UK wanting to build 10 plus reactors over the next decade or so. France wants to expand nuclear. China is expanding nuclear in addition to their goals of vastly expanding nuclear. And then you have the whole revolution of SMRs helping to shift positive sentiment, and that will actually be adding demand once we go out towards the end of the decade. All of this is to say that this is one sector that has a very, very bright future in terms of growth for the sector and the outlook for nuclear, especially considering the massive energy crises that we're seeing globally. The Wall Street Journal just published 4 days ago that in the United States, we should be expecting rolling blackouts this summer. That's something you typically don't see in the United States. Huge energy crises in Europe. So it's something that nuclear really fits the bill, and slowly but surely that narrative is gaining speed. In terms of how inflation is affecting the financial markets, clearly we're seeing the growth bubble essentially pop. We're seeing growth tech stocks down massively since their peaks. We've seen the NASDAQ down close to 30% this year alone, coming from that peak that was right around New Year's Day. Facebook is down huge. Netflix is down huge. The ARK fund is down unbelievably huge. Tesla, I mean, all these huge growth stocks are down in a big way. But as far as inflation is concerned, clearly the Fed is concerned about inflation, even though they will not necessarily acknowledge that a lot of the inflationary pressures have come from broken supply chains that were caused by COVID reactionary policies implemented by governments, and severely affected supply situations for oil and gas. And oil and gas is still essentially the fuel that powers modern society. So when you restrict supply via policy, that affects price. And when the price of oil and gas rises, the price of everything rises. So the Fed's brilliant solution is to kill demand. And how are they doing that? They're raising rates. It's really, when I don't know who I can attribute this quote to, but when the only tool you have is a hammer, everything looks like a nail. This is their one tool that they have, is to raise rates. And what that is doing is that's affecting the housing market, that's affecting the capital markets, and it's slowing down the economy. And so there's a number of recessionary markers that are starting to come in. We're looking at earnings reports that are coming in from the big retailers showing a shift in the buying patterns that are going away from discretionary spending towards essential spending, things like that. So we're kind of leaning into a recession here, at least in the United States. I think recession is likely already there in Europe. And the Fed is raising rates into a recession. So the markets are jittery. The markets are jittery about that, with quantitative tightening starting supposedly this week. We've already seen big pullbacks across the markets, but the market is certainly jittery here, and that's affecting essentially all assets.
So let's talk a little bit about that discretionary versus non-discretionary. I have a large position invested into uranium. As you know, I don't even want to say on a percentage basis, because I don't advise people to do the same. And one of the reasons that I've been invested heavily in uranium, I manage my mother-in-law's money, and she, I guess that some of that dumb luck got even better timing when she entered, and she's up in incredible levels, even after, a recent pullback in the overall equities market. And one of the reasons that I feel strongly about uranium personally is in that discretional versus non-discretional environment. You talked about killing demand. So if that affects the housing market, the equities market, but then you go back to discretional versus non-discretional, and it's pretty black and white that we need 200 million pounds. We're only mining 120 million. Most of it's being pulled off the market. You got Sprott buying so much of it. Countries increasing their growth into uranium. And so to me, the math on this goes, well, regardless of what's happening, this is a theme that is not going to be broken. And I was wondering if you could touch a little bit on that and some of the developing themes that have been happening lately.
Sure. Well, one of the things in terms of highlighting the non-discretionary nature of uranium demand, is that even in recessionary times, nuclear power plants are still operating. Okay, these power plants are not going to shut down because of a slight dip in energy usage, let's say. What power plants can do, they can flex up and down a little bit, maybe 10% in either direction. But for the most part, the demand for uranium is relatively static. So this is something that going into a potential recessionary environment here, and by the way, I don't expect this to be a long-lasting, brutal recession. I don't think that's what we're looking at, because it's really this is not just kind of a natural fallout of financial markets like we saw in 2008. This is absolutely engineered by poor policy. And what's happening is the Fed is tightening into the recession, and they're going to have to pivot. When that happens, that's what everybody is betting on. How soon does the Fed pivot? How soon do they pivot dovish? Because they can't only focus on inflation and completely ignore the markets. They have to find a balance. So the uranium demand is one piece of this where you might be betting on oil and gas. That's a really tricky one here, because supply continues to be constrained. But if the Fed hikes into recession, they kill 5 to 10% of demand, that's going to affect price. That's a difficult bet. Uranium demand is not going down because of a recession. So that's something that stays relatively static. And as far as the actual static demand and supply, that number this year, while it's huge, uranium utilities, the nuclear utilities, are sitting on a decent inventory. So that 1 year supply shock doesn't necessarily shock the utilities into action in real time. Everything moves very slowly. So what are we seeing right now, and what is happening right now? What's happening right now is we're seeing the later parts of the fuel cycle move up first. And so we've seen big moves in both SWU, which is separative work unit, that's the cost of enrichment, and conversion, and UF6. So these elements have moved in a really big way. UF6 moved over 50% in March. SWU moved over 60% in April. The month-end numbers just came in for May. We're seeing long-term U3O8 prices up $1.50. We've seen enrichment up again. UF6 and conversion, they sort of flatlined. I think they're down a couple of dollars, but still just off all-time highs for the cost of conversion. And so the later parts of the fuel cycle are what move first. If you're a nuclear utility and you see a potentially constrained supply environment going out into the future, and they're primarily concerned about Russia right now, it's not looking like Russia is about to be forgiven for what's happening in terms of supplying uranium to the West. So even though we haven't seen uranium officially sanctioned, what we're seeing is the nuclear utilities voluntarily avoid purchasing from Russia. Some of those nuclear utilities still have contracts that are being delivered, but even that is messy due to shipping constraints, due to, in some cases, the inability to ensure shipments that have any material coming from Russia or that originated from Russia. Longshoremen refusing to offload boats that are carrying materials from Russia, things like that. So there's definitely risk to those deliveries. So the utilities are doing what they can, which is seek out material as quickly as possible, which is the end of the fuel cycle. You can buy enriched uranium at the end of the fuel cycle, or you can buy SWU and feed the UF6 and buy the enrichment. Then you only have one more step. You've got fabricated fuel before you get that into your plant. So what happens is these utilities are seeking conversion and enrichment first, and that demand will trickle down to U3O8, which is the building block of that whole fuel cycle, the element that the miners deal in, and therefore our investments. So this always happens. You always see the back end of the fuel cycle move first. That's what we're seeing now. And we'll end up seeing kind of a slingshot effect where the tail of that fuel cycle or the beginning of it will get pulled up from the rear by the rest of the fuel cycle that's moving in a big way right now.
Interesting. That kind of goes with my hypothesis that you and I have talked about offline, where we just talk about our portfolios, and I've talked about why I have such a significant stake in uranium, but why I feel so good with it, given such a bizarre and deadly macroeconomic environment that we find ourselves in. there was a chart that fit into this whole equation that you mentioned earlier. Why don't you pop that up and show us how this fits in?
Sure. This is the chart I really have been focusing on a lot lately, just to see the relative performance of the uranium stocks to the broad market. So this is URNM, the Sprott Uranium Miners ETF, its performance relative to the S&P. And this trend line is very interesting. So the beginning of this trend started back in late 2020. And I consider December 2020 the beginning of the uranium bull market in terms of the equities.
And that was when we got that crazy move.
We got a big move out of the blue. Week 2 of December 2020, it just came out of nowhere because the spot price was just sitting flat. And we've come to find out, really in hindsight, it was 6 months after that we heard about Sprott taking over UPC. I would not be surprised if some smart money had heard some whispers of this prior to that, considering they had been working on it for a number of years. But we also had Larry McDonald's Bear Traps report, which is a large institutionally followed newsletter that issued buy orders on URNM and Cameco. And so that was December 2020. In my opinion, that was really when things started to kick off for the uranium equities. The uranium commodity bottomed in 2016, but really we saw the outperformance of the equities really start to hit in December 2020. So there's the bottom of our trend here, right? And if we zoom out, the technical bottom, it was March 2020, but that's such an anomaly. It's hard to even consider that here. So, and I'll show you another chart that's very similar to this in just a moment to get a wider perspective, because URNM has only been in existence since December of 2019. Okay, so the pullback, we peaked out after that first run in about May or June. And this outperformance of the broad market peaked out around the same time. Now we pulled back, and the bottom for the equities actually happened in July, but it made kind of a double bottom, bottomed out August, and then kicked off when Sprott started buying uranium with the Physical Uranium Trust in a huge way, just absolutely went vertical. Topped out in November, and this reverted back down, and we just bottomed again late January, early February. This trend line is held so far, and every pullback, and every time we've pulled back to that trend line, it's been a phenomenal buying opportunity for uranium equities. If you are to ride this for the long term or trade this, a reversion to this trend line so far has presented a really great entry. So what happens? This recent sell-off, when all markets went risk off over the past 6 weeks or so, uranium went really risk off, and we underperformed the S&P substantially since that sell-off in a way that really didn't make sense, because fundamentally uranium was and is incredibly strong. So what happened? We pulled all the way back to that trend line, made a quick little undercut low for a single day, and we've started to bounce back. Now I want to show you URA relative to the S&P, because we can get a much broader perspective on this chart. URNM I like to use for finer points because it's 100% uranium. URA has 70% uranium, but you can still get the gist of how early this is in terms of outperformance of the S&P by the primary uranium ETF. I mean, this is like inning 2, if you look at this chart, how URA can perform relative to the broad market. It is basically underperformed since its unfortunate inception
So that's
right
the
before
end of the
Fukushima.
last bull market right there. And then just total shit, boom, 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 boom. And then starting to make a rebound.
Yes. And this looks even more dramatic than looking at the chart of URA, because you're comparing it to the S&P that mostly went up during that time. We had some choppy years, but it mostly went up. So this is a very, very steep decline, a long bear market.
That's incredible.
Yeah. Look, URA launched 5 months before Fukushima. I mean, that was really, really poor timing, right? So they were just, they were just selling down their holdings and buying back shares for a freaking decade almost. Okay. So now we are finally in that turn. And if you look at URA straight up over this period of time, you can also see how early we are in this trend. And look at that volume. Look at the volume coming in. I mean, this is unbelievable. This is the trend lines I'm drawing here is what's considered a Livermore accumulation cylinder that we are still holding within, chopping around through this accumulation cylinder. And what ends up happening typically is this chops and it chops and it chops, and then it does something like this. And I could show you historical charts. I know we don't have the time, but this is kind of what we're expecting for this market.
Wow, that's interesting to see. I guess it shows you, regardless of the day-to-day craziness of whether it's geopolitical, supply chains, inflation, people panicking because they're wondering, is their mainstream stocks overvalued? Is it this? Is it that? But when you get out of all that noise and you get back to the signal, when we go back to the basic premise behind what's interest you, me, and people listening to this uranium, you see there's a long way to go, huh?
Oh yeah. And the moves, I mean, what interests you and what interests me, obviously, if you have a large percentage of your investable money in uranium, you like risk. I mean, I think that's probably a fair statement. Right? It's a risky sector.
There's don't like it, volatile. But I like it at the same time. It's like such a crazy story. Like, what on earth can you have this type of negative supply demand on something that is so important? It's it's just crazy to see it. But it's the worst. But it's like the worst, like economic fiat currency climate in history.
Yeah. Yeah. And to couple that supply and demand story for an essential industry with a very small basket of possible investable equities in the space. So, there's only 70, maybe 75 uranium companies right now, and it peaked out at close to 500 in 2008. We obviously we drilled that down into the what we feel are the best 10 options within that space. The best 10 companies within space based on our own formulas. And as a member, you obviously know how we've done with that so far. But it's such a small sector. When the capital flows into it, it moves in an unbelievable way. So that's really the bet here. The bet as a contrarian here is, will capital flow back into the uranium equities? That's the question. So I tend to ask myself, is the uranium bull market over at $48 uranium? That's the first question. These are rhetorical questions, generally speaking, for myself. Obviously, no. Would Sprott work on taking over UPC for 3 years, only to essentially just? I think we're kind of done here. No, in my opinion, the financial markets are going to go back to risk on as soon as the Fed pivots. And when that happens, I think that we will see renewed money come into the sector, because what has happened over the past few months in terms of awareness of this investment is really interesting. Do you know who Hugh Hendry is? Very eclectic dude, former hedge fund guy, very, very esoteric and intelligent. I listened to a recent interview of his. I tend to follow him, I find him entertaining, but I think he's also brilliant. He mentioned, he was talking about a hypothetical portfolio of what he was looking at right now. He was like, I'd probably own a little bit of BHP Billiton, maybe a tiny amount of Bitcoin, definitely own some gold and uranium. That's it. That's all he's interested in. Uranium is one of them. We've heard Chamath on his podcast. He was talking with a number of just Silicon Valley techies. They were all super bullish on uranium and nuclear. So we have, and I could give you a bunch of other examples of that, but it's a thesis that is becoming more and more, not even mainstream, but just in the sights of intelligent investors. And I believe that this is going to come back in a very, very big way. And we're going to have a move just with a vengeance.
So do you think uranium trades around until the Fed pivots? And my personal feeling, whatever it's worth, is we got midterms coming up. They're going to need some new all-time highs. So, or else I don't think it's going to fare so well. What's your opinion?
Yeah, that's a tough question. Are they going to chop around? Well, I mean, I'm watching the volume. So I'm looking at the volumes into the ETFs and into SPUT, and it's just not there yet. SPUT, the setup is ripe right now for SPUT. They're trading at a premium to NAV. it would be very easy for money to fly into that thing and start to move the market again. And it's not happening. So in my opinion, we are still in a risk-off environment for institutional money. It's possible over the next number of months that we could see hedge fund redemptions come in and create more selling pressure in the markets. That's possible. I do think your thesis on the midterms is valid. I think that the Fed and the current administration are going to have to try to balance the harms that inflation is causing and the market crashing. I don't think they can just throw the market out as the baby with the bathwater and go all in on bringing inflation down. I think once we start to see, by the way, I think inflation is probably not long-term, but at least in the short term is probably peaked. I think we'll see the CPI numbers in the next few months start to show lower numbers, which could give the Fed an excuse to soften at least. But yeah, I don't think crashing the market into the midterms is a good strategy.
Yeah, that's a good way to say it. So we want to thank you for joining today. We want to encourage everyone to check out Uranium Insider newsletter. I'll link it in the description and pin to the comments right there down below. I'm a paying member myself. If you want to see the 10 most viable uranium mining stocks that Justin and his team have broken down, you can check that out. It's also just a fantastic resource to understand the macro environment for this. One of the reasons I am heavily invested in uranium and why I care a lot about it is because to me, it's not a 4-month thing. It's not a 6-month thing. From a long term, whether that's 12 months, whether that's 36 months, this theme is getting bigger and bigger. So if you want to understand that more, I recommend you check out Uranium Insider, linked right there down below. If you enjoyed today's video, give us a comment right there down below. Let us know what you think. Smash the like button on this, subscribe, bell notification, all that fun stuff. Justin, is there anything I missed?
No, I don't think there's anything you missed, but just final thoughts with your audience. I think it's really important to look at historical charts, and charts, more than predicting the future, obviously tell you the past. And so I think that if you are bullish on uranium, if you are supportive of nuclear, if you believe in this thesis for at least the mid and the long term, then look at charts in the past and look at where the charts had bottomed out, had pulled back severely, and ask yourself if that was a good time to invest in the space. Because what happens is you have these pullbacks and they can be gut wrenching and it affects sentiment. Sentiment is pretty bad right now, not just for uranium, but I mean, sentiment is actually somewhat positive for uranium, but not for necessarily the investment because it pulled back so much. I know that you talk with Rick Rule a lot, and he gets unbelievably excited and genuinely greedy and excited when markets do this. And every time these shares are dropping, and I'm a long-term investor in this space, so I tend to just weather these ups and downs, and I think I'm better at it than most. But when the sentiment is poor, when the stocks are at a 40-50% discount from their peak, that's the time to be getting aggressive and to be getting interested in putting some money to work. And when people are doing cartwheels in the streets, that's the time to take some chips off the table. Now, ask yourself where we are at right now in that cycle between despondency and euphoria. We are closer to despondency. That doesn't mean it's the bottom. That doesn't mean that there couldn't be a little bit more weakness ahead. But we're seeing supportive numbers across the fuel cycle. And obviously the use case and the growth case for nuclear is phenomenal. It's better than it's ever been as long as I've been following this market. So with all of that said, if you have a contrarian bone in your body, these are times when you should start be getting interested and greedy in sectors that have been unjustifiably sold off due to correlation with risk off across environments.
Well said. So we want to thank you for joining today, Justin. We want to thank you for watching. You can check out Uranium Insider newsletter right there down below, and we will see you on the next episode.